Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
All right, welcome. Today, we're diving deep into the key differences between IFRS and U.S. GAAP when it comes to accounting for long-lived assets. And let's be clear, these aren't just minor technical points. As you're going to see, the differences in how we measure and impair these assets can have a massive impact on a company's financial statements.
So here's our game plan. We'll start with the basics, property, plant, and equipment. Then we'll move into the trickier world of intangibles. After that, we'll tackle the really big one, the huge divide on impairment. We'll cover a few other key divergences and then wrap it all up by looking at the practical impact this all has on the numbers you actually see.
Okay, let's kick things off with property, plant, and equipment, or PP&E. Now, both frameworks pretty much agree on how to record an asset initially, at its cost. But right after that, the paths really start to split. And here is the single biggest philosophical split you're going to find. U.S. GAAP is all about reliability, so it sticks strictly to the historical cost model, period. IFRS, on the other hand, says, well, maybe fair value is more relevant information for investors, so it actually permits companies to revalue their assets, even though that brings in a bit more subjectivity.
Now, the details under IFRS are absolutely crucial to understand. For your standard PP&E, any revaluation bumps go to other comprehensive income. But, and this is a big but, IFRS has this whole separate category called investment property. If a company opts for the fair value model here, those value changes go straight through the income statement. You can imagine the kind of earnings volatility that can create, something you just don't see under U.S. GAAP.
This level of detail even trickles down to depreciation. IFRS requires you to break down an asset into its significant parts and depreciate each one separately. Think about an airplane. The engine doesn't last as long as the fuselage, right? IFRS says you have to account for that. Under U.S. GAAP, it's allowed, but honestly, it's not something you see very often. And get this, even when you're capitalizing borrowing costs while building an asset, the math is different. For example, under IFRS, if you temporarily invest that borrowed cash and earn some interest, you can use that to reduce the amount of interest you capitalize. U.S. GAAP says, nope, can't do that. So all things being equal, an IFRS company could end up with a lower asset cost on the books. Okay, let's shift gears and talk about the stuff you can't touch, intangibles and goodwill. The differences here, especially with assets developed in-house, can lead to balance sheets that look wildly different from each other.
So picture this. A company is pouring millions into R&D. Under U.S. GAAP, the development part of that spending is almost always expensed as it happens. But under IFRS, once that project hits certain milestones, like it's technically feasible and commercially viable, you have to start capitalizing those costs as an intangible asset. That's a huge difference for both the balance sheet and the income statement.
Now, when it's time to test goodwill for impairment, you have to know what you're testing. Under U.S. GAAP, the key term you need to know is the reporting unit. Think of it as an operating segment, or maybe one level down from that. IFRS has its own version called the Cash Generating Unit, or CGU, and the key here is that it's the smallest identifiable group of assets that brings in cash on its own. This means a CGU is often a much smaller, more granular piece of the business than a reporting unit, and that has some serious implications for how sensitive the impairment test is.
And that's the perfect lead into what is honestly one of the trickiest and most impactful areas of divergence, impairment. How and when you recognize that an asset has lost value is a whole different ballgame between these two frameworks.
U.S. GAAP uses this very deliberate two-step process. Step 1 is a simple check. Is the carrying value of the asset more than the undiscounted future cash flows it's going to generate? That's a pretty high bar to clear. It's only if you fail that test that you move on to step 2 to actually calculate a loss. This can really delay when an impairment gets recognized.
IFRS, totally different. It's a much more direct, one-step approach. If there's any sign of impairment, you jump straight to measuring the loss. There's no preliminary check with undiscounted cash flows.
So how do you actually calculate the loss? Well, again, they're different. Under U.S. GAAP, you compare the carrying amount to the asset's fair value. Under IFRS, you compare it to the recoverable amount, which is the higher of its fair value or its value in use. Since value in use can often be higher than fair value, you could end up with a smaller impairment charge or maybe no charge at all under IFRS.
Here's a real game changer. What happens if an asset's value bounces back after you've impaired it? Under U.S. GAAP, too bad. That loss is permanent. You are strictly prohibited from reversing it. But IFRS says, hey, if the value comes back, you should reverse that loss, and you're actually required to. This means you can see gains popping up on an IFRS income statement that would be impossible under U.S. GAAP.
For goodwill specifically, U.S. GAAP gives you a little bit of a break, an optional shortcut called Step 0. It lets companies do a quick qualitative check to see if it's more likely than not that goodwill is impaired. If things look okay, you can skip the big, hairy quantitative test for the year. IFRS offers no such off-ramp. You have to do the full quantitative test every single year.
Okay, let's wrap up with a few other really key differences that you'll definitely run into, covering everything from crypto to spin-offs.
This table lays out some interesting ones. First, U.S. GAAP now has specific rules for some crypto assets, pushing them to fair value. IFRS is still figuring it out. Leasehold improvements can be amortized differently. But let's talk about spin-offs, because this one can be huge. Under U.S. GAAP, you spin off a business at its book value. Under IFRS, you have to use fair value, which can suddenly trigger a massive gain or loss for the parent company.
Okay, so we've gone through all these individual rules, but what's the big picture here? When you step back, what does this all mean for the financial statements that we as analysts and investors are actually looking at?
Well, at the end of the day, it boils down to this. An IFRS balance sheet will often show higher asset values thanks to things like revaluation and capitalizing development costs. That, in turn, can lead to more volatile earnings on an IFRS income statement. And kind of funny, even though U.S. GAAP seems tougher, that one-step impairment test under IFRS can sometimes mean you actually recognize losses sooner.
So this really leaves us with a big question to chew on. Which one of these frameworks actually gives us a better picture of what's really going on in a business? Is it the reliable, steady historical cost of U.S. GAAP, or is it the more relevant, fair value approach of IFRS? There's no easy answer, which is exactly why understanding these differences is absolutely essential for anyone trying to make sense of global financial statements.